Hello, passive investors. Welcome to Passive Pockets presented by Equity Trust. I'm your host, Paul Shannon. A critical part of investing is knowing who you're investing in. So today we're going to meet Sean Kelly Rand, managing partner at RD Advisors. Let's jump into it. Sean, welcome and thanks for supporting the Passive Pockets community.
Thanks for having me on. It's great.
Hey, to start, tell us a little bit about your company and what you focus on in the world of real estate.
Today, where are we? So, I've gone through all sorts of real estate, from direct investing to investment banking to private equity to financing, all from small individual projects to, multi-billion dollar projects on the banking side. And so where are we today is on the real estate lending side, specifically in Boston. So we run a niche real estate private credit strategy called RD Real Estate Debt Fund 2. And that is focused on lending to real estate developers in the greater Boston market.
All right. So how did you first get into this space or this niche within real estate?
Well, go back. And so why did we do it, right? We looked at it. And so my business partner is a family office and we'd known them for years. We started in 2017, which is about 10 years after the last financial crisis. And at that point in time, we'd both done well, kind of buying real estate out of the financial crisis. And that was kind of a foundation for, some wealth. And we said, how are we going to preserve that? And what do we need to do going forward, right? And so starting in 2017, we said, hey, listen, we don't know when the next crisis is going to happen, but by the time we're in it, it's too late to shift strategies. So what we need to do is get into a strategy that we're comfortable riding through the next crisis. And so we said, what do we want? Well, it's got to be somewhere senior in the capital stack. So it has to be senior debt. Two, we need some yield. If you go back in 2017, and then especially through kind of where we've been through on the lower interest rate side, it was very hard to get yield. And I will say even today, it's hard to get real yield, right? So, not just treasuries, not just bank account yield, but proper yield coming out of properties and real estate that's generating some wealth, not just the kind of like toss it in the bank account yield, right? So we wanted to get real yield. And then that capital preservation part was it. And then the other big thing that was important was duration risk. And I think a lot of real estate investors and kind of guys in the bond side really think about this, but real estate investors don't think about it as much, is you want something that's shorter duration so that you're constantly churning it. So you're not sitting on something that you did 5 years ago in a market when it's declined. And so from a lender's perspective, you want to keep those loans as short as possible. And so what we ended up doing was going into the bridge and construction lending space. But really, this is kind of short-term fix and flip lending, construction lending, and bridge lending. And that's, and then over time, we shifted from kind of doing a little bit all over almost as an allocator and a family office. They were direct deals, but we were kind of diversifying within that to then a focus on a single market where we were the experts. It's hard to enter, and building a moat around it and a platform to make ourselves kind of best in class lenders in that market. And that's kind of, greater Boston has become that market. And you kind of just think of greater Boston as almost, when you drive 2 hours around it, it's kind of like New England area.
Definitely going to appreciate the thesis and the shift towards more of an income producing strategy and preservation of wealth. So you built some of that wealth during the great financial crisis. You wanted to preserve it. That's when this pivot happened. RD Advisors was born out of that. I'm sure there were some mistakes along the way, right? Can you share with us one mistake that sticks out in your head as it relates to something that happened in your real estate investing career?
Yeah, I think one, I think stick to, senior debt. Just to give you a perspective, I came out of Lehman Brothers in 2008. I didn't leave the company left me. I'm not going to go through that whole Lehman Brothers saga, but there was tons of learnings there. And, Lehman Brothers itself was 30 times levered. And so I think one of our learnings when we set up RD Advisors was, hey, we're going to have some back leverage to help with the operations and the cash flows to make sure that the deals are always working, the investor capital is always working. But we really want to make sure that we keep that leverage at a level that is very easily covered and it's relatively low leverage at the back end because, when you want liquidity, it's not going to be there. So make sure that you've got loads of cash and you keep that leverage low. Another big mistake that we went early on when we were lending, and again, we're kind of saved because we do 80 to 100 loans in the portfolio at one time. So there's a lot of diversifications. But we've done some loans where, we went into it and, I think we've done due diligence, but we didn't count on a borrower committing fraud. And we had a borrower commit fraud against us early on, right? So we didn't do as much due diligence on the sponsor. And actually, we did plenty of due diligence on the sponsor, but things changed, right? And I think they got desperate and they committed, and we didn't monitor it as well as we should have, right? And that's another reason we went into being 100% local as an operator is I think there's a lot of things that people think they can know on the surface. You can do as much due diligence as you want, but really what you find from being an operator in the market is You know the market, you know the sponsors, you know the borrowers. They're in your universe. Everybody knows each other, and it's a tight loop. And that's one of the things that we benefit from being in Boston is everybody kind of knows who we are, right? And we kind of know the main players in the industry, and it's very easy to go ask a reference. Hey, can you tell me about this guy who's coming in? I don't quite understand this situation. Oh, hey, there's a permitting situation, right? Me doing a deal out in Indianapolis, I'm going to miss some permitting stuff, right? I'm going to look at a deal and go, oh, this makes sense. But I might not know that there's a certain law on condo conversions, right? Boston area, I'm going to know that stuff because it's in my area every day. And so that was one of the reasons we just said, hey, we got to hone in and really know our market extremely well and be the best in class in that market.
Sean, I call that an unfair advantage. And I think that is so critical to success in real estate because you don't know what you don't know about other markets. And there are so many different rules, regulations, laws, municipal, ordinances, et cetera, et cetera. So, and then there's the street by street knowledge too, right? I mean, you could see a general area and feel as though, oh, if you look at a CoStar report, it may look great on paper, but until you actually get into that area and drive and see the back alleys of that neighborhood, you don't really know what you're buying. So totally resonates with me. And maybe this is a related question and it's already been answered, but what do you feel is the biggest factor in your success as a real estate investor?
I think being cautious and being consistent, right? I think there's a time period to go all out and being aggressive. And I'm kind of the oak tree school of just don't lose it, right? Year after year, have consistency. Deliver year after year returns. Don't go for one big return in 1 year and have volatility. We've been rewarded by our existing investors in the sense that our largest source of investment is our existing investors re-upping their investment and, having investors kind of refer. And why do they do that? Because we said we were going to do one thing. We said we're going to deliver a certain type of returns. And year after year, we're able to do that. Why? We're not shooting for the moon. We're not doing this. We're just plodding along, doing senior debt deals. And some days it can be a little bit boring, right? Like I'd love to be out there and be like, we're going to do this brand new development that has a projected return. No, we don't talk about projected returns. We talk about an 8-year track record. And during those 8 years, here's what we've returned. And here's what you can probably expect going forward, right? It's a little bit more boring like that. But I think investors have really found that consistency is what drives their interest in the strategy and allows them to feel comfortable re-upping.
Boring is good when it comes to investing. Getting emotional about investments is not.
Yeah, we try. I mean, it's, everybody wants to have, look, allow yourself to have that one investment that you get emotional about, right? That is exciting. I have a few investments in my own portfolio. They're outside of real estate. They're in real estate where I'm like, you know what? There's a 50-50 chance I'm going to lose it all on this deal. It may not even be profitable enough to make it worthwhile in that, but I just want to do it, right? But that's a luxury investment. I'm not investing that for there. It's the same reason somebody might buy a luxury car. It's not a great investment, but you just want to do it, right? And it's a good way. But the vast majority is in stuff where I'm like, I just don't want to lose this.
Yeah, you're talking about portfolio construction. There's certainly areas of or corners of a portfolio where you can take outsized risks, but on the whole, you want to have diversification and a sound strategy that's going to produce consistent results, right?
And I speak with, literally throughout my career, spoken probably thousands of real estate investors and developers, right? And we probably have 100 plus developers in our network that we've lent to in Boston, maybe 200, 300 that we've spoken to. I've got 14,000 followers on LinkedIn. Most of them are real estate developers and finance professionals. We speak to them day in and day out. And you'll hear stories of guys that go out there and every year they shoot for the moon, right? And so they build all this wealth, right? And you go 20% year over year, 30% year over year. And then boom, financial crisis hits and it's 100% loss. And so you've piled up everything and you have 100% loss, right? What we're trying to do is the antithesis of that, which is small returns consistently year in, year out. Don't ever lose it. And that's, capital preservation on it. And that's our main strategy. We also are going to launch a mezz fund, a preferred equity strategy to kind of capitalize on some of these recapitalizations. But it's less going into deals and it's more helping people get out of it and being rewarded for that kind of last dollar in. That's a different strategy than our main strategy.
Now, do you take the same approach in your personal portfolio as far as allocating towards different risk tolerances and asset classes? Tell us a little bit about your personal portfolio. Are you invested in syndications outside of your own fund?
So my personal portfolio, most of it is in real estate, right? Like I'm the classic real estate guy. I grew up, my dad was a carpenter. My mom sold Fannie Mae foreclosures in Boston in the 90s, right? So if I wasn't swinging a hammer with my dad or my uncle, I was, crawling in a basement window to open a front door, right, on a dilapidated home somewhere in Boston. So that's what I knew. I grew up in kind of the hood and then got into real estate because that's all I knew, right? Like I wasn't going to be a doctor and I wasn't going to be a lawyer. What else was there that made money? And I was like, all right, well, this is it. And this is what I know. So that's how I got into it. I mean, original house hack, I'd saved up money. By the time I graduated college, I'd saved up money so that within 3 months of graduating college, I bought my first, 3-unit building. Lived in 1 unit, rented out 2, and even had a roommate. I think I was getting more cash flow from that than, part of my day job, by the end of it, and sold that out in '06, right? I saw the crash coming. I put it on market and marked it down. I said every single week, I don't know if you remember Filene's Basement, but if it didn't sell, they marked it down like every week or every 2 weeks by like 10%. So I marked it high and then dropped it every single week till I got an offer. Sold it for twice what I bought it. Used that to pay for, Columbia Business School. I graduated, went to Lehman Brothers, kind of went through that bank collapse, came out of that, did debt restructuring for a year. And then I was hired by Madison International, which is about a $4 billion, real estate private equity fund to launch their London office. And so at that time, I started buying real estate in 2010. And I did it with my mother, who used to be, on the Fannie Mae side. So I was in London and I had a huge board on the wall mapping out, all the real estate that we wanted to buy. And we picked a neighborhood, kind of same thing. We kept the focus. We said, all right, we want everything to be kind of within 5 minutes, driving, and have a theme that if we buy one property and we repair it, that we're improving the property next door. Well, we might as well own that property next door. So we'll try to buy everything on, we'll pick streets. We did that kind of 2010 to 2014. We bought probably, I would say about 70 units. We churned a bit within there, probably at peak, we had about 70 units. We were levered to the hill, right? Coming out of Lehman Brothers after paying off business school and all that, we don't come from a wealthy family, didn't have much. We kind of stopped and paused because we needed that yield to pay investors. Then we were able to refinance a little bit later. We sold some condos. We did condo conversions. We did some developments. But that was so much stress, building from 0 to 70 units with no money. And this is Boston, right? Like, properties are expensive. And we did so many repairs, evictions, all that. It was a huge lift and a mental toll that kind of by 2015, I'd said, hey, I need to take a break from this, right? I have this was alongside my day job, right? And so by that time, I'd said, I need to relax. My heart rate and my ability to sleep, I was taking years off I was building wealth, but I was taking years off of my life, right? And, starting a family and all that. And I think a lot of investors can get the handle of it. But, we went into a concentrated neighborhood. We made one big bet at that period of time because it was worth it, right? We thought, and we made a multiple. I mean, you can imagine if you bought in 2010, you held it to today, what we've done on that. And we never added debt to it. We never, we never really cashed out. So we kind of just kept that portfolio, sold off some condos, paid down debt. And so we sit very low leverage, cash flowing on, Boston real estate investments that are in, kind of emerging neighborhoods. And, now we've kind of 1031 over time to try to go into a few larger projects. But again, kept it very casual. I've handed off all that management to my brother, my family. We've hired some people. We have our own property management. So it's kind of now I'm a passive investor in a portfolio that I built. So I built it, but I actually, I don't see the operating accounts. We decided at a certain point in time that seeing the operating accounts gave me heartburn, right? So every time, I saw it, I couldn't not comment on like, why did we just spend $50,000? Where'd that money come from? Where's it going? So I got cut off from all of it. And now I look at it as a passive investor, right? I'm happy somebody else has control of it. I get my distributions and dividends. And I feel kind of like I've created my own trust fund, like, hey, why don't I get my, where's my distribution, right? And that's nice. I mean, it's nice that I know it well enough. I create it. And then, so that is my, kind of like part of my passive. And then my active is other people's passive where I'm running, RD Real Estate Debt Fund 2. That is my active every day, all day. And one thing to remember there is the original investors in that for the first 4 years, we're 8 years in, were myself and the family office. And we still remain, jointly over in that and the employees, we're over 50% of the fund. I mean, that is kind of, we're doing it actively, we're doing it, and we're doing it as if it's our own money because the vast majority of it is our own investment. And, investors are coming on and kind of participating with us in kind of this kind of wealth creation and, kind of wealth preservation as well.
That's quite a collection of experiences. Very impressive, and related to your handing off of your sort of personal portfolio and making it passive. Is that what financial freedom means to you? We talk a lot about that in our community. I think it means something different to everybody, whether it's fully replacing their W-2 income and sitting on a beach, or just supplementing their income from a job they actually like so they have less reliance on it if something bad happens. But what does it mean to you, that term, financial freedom?
I had some good investments that we were able to do well kind of in that 2010 period, right? And so, there is some passive income to that. And so in theory, I could jump off and go live somewhere and not have to work. Would I be able to afford all the luxuries that I'd like in life? Maybe not. But I'm a pretty simple guy at the heart of it, so probably. But a lot of it is being able to step away. You don't have to step away, but knowing, and this is one thing when I was working in private equity, right? It made me better negotiating with any sort of job, knowing that I wasn't ever fearful that my boss is going to fire me, right? I could go into a negotiation and say, hey, listen, I don't need this role, right? I can survive without it. Like, I'd like to like this role, but here's the role I want, right? And kind of so for my, career, up to the point of my launching RD Advisors, I was always able to have roles that, I was able to map out for myself, because I could say and be honest about it. Like, look, there is the BATNA, right? The alternative is I just go back and run my portfolio full time. So it put me in a much better negotiating position. And so it's not complete financial freedom, but it's also not having to worry about where your next paycheck is coming from mortgage, right? And so that's where I think a lot of this, when we talk about our yield generation strategy, right? Having a strategy that generates consistent yield, right? You can't eat IRR, right? IRR is not going to put food on the table, right? That's how we set it up. A consistent dividend and cash yield from interest income will put food on the table. And so I think that's one of the things that makes a big differentiator in terms of what we do, is we're delivering that yield that, somebody can put a significant amount of money in the fund and go live off of it. We have people that are, they're invested in the fund, and they're, I don't know if they're fully living off it, but those dividends and distributions are going to living costs.
Makes sense. All right, we got time for one more question, Sean. Here's a big one. So if I'm a passive investor just getting into, let's say, debt funds specifically, since that's what you do, what should I be considering? What should I learn to maximize my success in this type of investing?
I think a couple of things. One, my advice is go with local sharpshooters. There's national players out there, but that means they're a jack of all trades and ace of none, right? You want to be with the aces. And so whether it's with us or, some other group, you want to be with somebody that's a sharpshooter and really knows their market, because when shit hits the fan, they have to be able to take over the project, right? So if somebody's in San Fran and they're, lending in Boston, they can't take over the project. They're not going to know the developers, and they're probably going to get involved at too late. So think about whether they're local or national. 2, really look and see the market they're in, if it's judicial or non-judicial. You really want to be in non-judicial markets. Judicial markets are Florida, New York, among others, about half the states. Those have a much longer foreclosure process, which means when things go bad, they go really bad. Massachusetts is non-judicial. It means you don't have to go in front of a judge to foreclose. So that's similar to Texas and a couple of other places. So that's hugely important for a strategy, because it means that you really have power as a lender. And then the third I would look at is look at the back leverage on the fund, right? So, some back leverage, in my opinion, is not bad, right? You want to have that operational leverage because you want to be able to say, hey, I want to stop lending, right? So I want to put my brakes on. Well, if I put my brakes on and don't do lending for a quarter, then the loan back leverage just pays itself down, right? And then you're not sitting on cash, and then you can lever back up. But too much leverage means what happens is, you go back, and we did really well coming out of the pandemic because of a lot of our competitors were highly levered in Boston, and they blew themselves up. And so we were the only there. Well, their investors got screwed, right? And so that was one of the things, like, you want a little bit of back leverage, but not too much. And what's a little bit? I don't know. Somewhere between 20 and 50% back leverage seems comfortable to me, in my opinion, just having done this for 20 years. That 70, 80% ticks up very quickly when things go wrong. And that's somebody's going to offer much higher returns, but that's not why you invest in a debt fund.
Makes sense. Well, Sean, it's been a pleasure having you on today. Thanks for sharing some of your insights and giving our listeners an opportunity to get to know you a little bit better.
No, it's been a pleasure. And I'm looking forward to hosting you in Boston and showing you around and, up and through our offices and walking you through the streets and going for some good food.
Good stuff. Thanks, Sean. And that wraps up this interview with Sean Kelly Rand. Be sure to check out our YouTube channel and subscribe to our podcast for more great insights in the world of syndications. Thanks for tuning in. And as always, happy investing.